welcome to Davos 2012. Joining me today is Gerard Lyons, Chief Economist and Group Head of Global Research at Standard Chartered. Ms. Lyons, thank you very much for your time.
Pleasure.
Let me start by asking you what you make of everything that you hear at this conference. We've had, just before the annual meeting start, the IMF downgrade its outlook on global growth this year. A contraction in Europe is expected. What's your assessment of the global economy?
Well, I think the global economy is cooling, but it's a very divided world economy, and it's a very disconnected world economy in the sense that it's not the same picture everywhere, and there are clearly some big challenges which have come to the fore here at Davos. But in terms of the world economy, Europe is in recession, the UK is in recession, America is growing at a steady, not spectacular pace, and the emerging economies, India included, are cooling down. They're not collapsing. And here at Davos, I would say that the mood has, in previous years it was quite pessimistic actually. I would say there's a greater sense of realism this year, that feeling that there are sort of issues to be addressed, there is progress being made. But perhaps the biggest worry here at Davos, and naturally so, is the continued problems in the euro area and the eurozone.
And that is the question the markets have been asking for a very long time now. How much worse is it going to get? So I think we're confronted with various different scenarios. The possibility of a default in Greece, the possibility of that default being a disorderly one, and what that means then for the contagion impact on other countries, for instance Portugal, maybe even Italy, and that's the frightening scenario. What do you make of how much worse it's going to get, especially on this default front?
Well, ideally we'd like it to be sorted, and no one wants the euro to fail, no one wants the euro to continue to run into further problems. But the reality of the situation is that European politicians and European policymakers have acted far too slowly and have not been comprehensive enough. Therefore, rather than nipping this problem in the bud, they've allowed the Greek problem to continue to fester. And the underlying structural problems in the euro are very evident. I tend to say good economics is good politics. Good politics is not always good economics. And the greatest challenge with the euro is that politics has driven the whole process. I think some of those underlying problems therefore are coming to the fore, particularly as the European economy remains in a very difficult economic situation. In fact, I think Europe is in recession. In terms of Greece, the mood here in Davos is quite interesting. I would say if we had had a vote a year ago, people would have sort of said, of course it would be resolved. I was at a private meeting yesterday where people were asked in a straw poll, 40 people there, including some important people, shall we say, how many people thought one country or more would leave the euro in the next year. Half the people put their hand up, which I think is very telling. I think Greece will actually have an orderly default, but I then think the big question at the end of this year is whether Greece leaves the euro. I think Greece will leave the euro, primarily because I think to take continued pain, you need to see light at the end of the tunnel. Greece will, by the end of this year, have had 5 years of economic pain in terms of recession. I think it will then probably face another 5 years of recession, and I don't think that that pain is justifiable. Now, of course, staying in is costly. Leaving the euro is also costly. But all I can say is that there are continued problems. Maybe on the positive side, what's happened in the last few weeks in terms of the European Central Bank providing ample liquidity has been a very positive feature, and I think people here at Davos recognise that. It's bought time. Time is a very scarce commodity, but it's a very important commodity. Even though time doesn't resolve the underlying structural problems, it does allow companies, banks, and who knows, maybe even politicians to start reacting.
Okay, let me take the 3 points that you made in your answer in reverse order. The first one about what the ECB has been doing in the recent past, and the fact that the IMF is now talking of a $500 billion fund to add to the ammunition to be able to help beleaguered countries in the Eurozone. Is $1 trillion enough? Will it help this problem subside to some extent at least, or will we need more? Or do you feel that no matter how much money we throw at it, the fact that Greece will have to default and that it will leave the Eurozone is almost inevitable?
No one knows for sure how much money is needed. It depends on the sort of next stage of the crisis, shall we say. But to put it in perspective, back in September I was in Washington at the time of the IMF, and then people were talking about numbers as high as 2 trillion euros. But again, no one really knew. But the key issue is that if there is a problem, say in Greece, can you have enough of a firewall to prevent the problem spreading, say, to Portugal and indeed engulfing Spain and Italy? And if you want to have a big firewall, you want the firewall to be so big that people think it's not only big enough, but bizarrely enough, you don't actually have to use it. Something around 500 to 1 trillion is not big enough, therefore people know it's not big enough, and the bizarre thing is that then you probably do end up having to use it. So it's the market psychology is important, but you have to have a big enough firewall, and I don't think the firewall has been talked about at the moment are big enough. And the IMF really has been seen in my mind as a sort of European bailout fund. And that's the challenge. Europe needs to sort out its own problems. The IMF clearly needs to help if necessary, because the global contagion will be significant.
If they were to come up with more money together, both the EU, the ECB and the IMF, through the various stability mechanisms that they're talking about, do you think that could to some extent sort of help Greece not have to leave the Eurozone? So is there a chance at all that Greece may not have to leave the Eurozone?
Of course there's a chance Greece may not have to leave.
What would it take for us to be there?
Well, Chancellor Merkel was speaking a couple of nights ago, and I was listening to her, and she very much put down a hardline German message. No more money. The peripheral economies, even though she didn't use that term, will need to adjust. So Greece needs to take the pain, was really the message. There's no new bailouts from Germany. Now, it's like a game of poker, maybe. You don't want to show your cards until the last moment. I think Germany maybe is reluctant to provide further help, lest it takes the pressure off Greece and others to adjust. So for Greece not to leave, I think it needs to be showing progress. It needs to be moving back to a primary surplus. The population needs to have confidence in the policies, and then there needs to be further aid provided either from Europe itself or from the IMF. So there is still pain in either scenario.
Can I assume from the conversation we've had till now that we're finally, therefore, because of the suppression of demand, because of all the sovereign issues that we're facing, we've entered a low commodity price cycle?
No. Speculation is obviously one of the factors, but once you take that out, it seems to me that we have a firm floor, soft ceiling for commodity prices. There are obviously many different commodity prices. The key one is naturally energy. Geopolitics in the Middle East and the Gulf doesn't really help. So the firm floor is strong underlying demand from the likes of India and China. Soft ceiling is that geopolitics can push energy prices higher, and also in terms of food prices, obviously supply shocks can push prices higher. The world economy does slow, then that takes some of the heat out of these markets, but even so, the underlying demand there is a firm floor on the commodity prices. If we think of it in terms of this, world economy 2 years ago, 2010, was probably growing 4.4%. 2011, the world economy probably just grew over 3%. Our view at Standard Chartered this year, the world economy will grow about 2.2%. So that is a cooling situation, but not cooling enough to mean that commodity prices start to fall.
My final question to you is about India then. Where does it rank on your list of growing countries? What do you make of some of the fiscal issues we're facing, and therefore your outlook on India?
Well, I'm positive about India, but I went to India about 4 times last year, and what I felt was that each successive visit, the locals were becoming more pessimistic than foreigners. And when foreigners look at India, they see the longer-term potential. But speaking to international investors recently, questions such as corruption, infrastructure, and of course inflation are uppermost in their minds. And when people look at India, they're also looking at comparisons of India versus, say, Brazil and other economies. I was in Brazil, it has to be said, in November, and there were concerns as well. So maybe as economies like India and others start to realise their potential, it naturally forces people to focus on the challenges ahead. I think it was disappointing that last March we didn't really see a lot more push in terms of some of the supply side regulatory issues, and I still think those issues need to be addressed, but of course as you start to move later in the political cycle it becomes harder to do so. The good thing for me about India is the Reserve Bank of India, I think, does a great job. I think the macro policy advisors one has in Delhi as well and around the place are pretty impressive people, so I think they know what needs to be done, but maybe it's a case of lowering expectations about growth. It's not spectacular growth, it's more steady, sustainable growth. But I think the underlying picture is one where consumer demand should remain resilient, particularly if inflationary pressures do ease off. And then it's about whether corporate investment will start to pick up. So India, I think, should have a steady pace of growth this year.
All right, I'm going to leave it at that note. I'm sure the RBI will be very happy to hear what you had to say.